Hey, welcome everyone. I'm Ted Erhart. I just want to share with you a couple market indicators that are suggesting slowing economic activity, potentially recession. They're really striking, but what's also interesting to me is they come alongside other data that is contradictory, which we'll talk about in a moment. I'm always fascinated by things that are counterintuitive or, as I mentioned already, contradictory. So let's get into it. So the first market signal I want to talk about is bond yields. And this is something I actually talked about a couple months ago. For the second time this year, the bond market is really throwing us a flashing red light and saying recession is very likely to occur in the next 12 to 18 months. And what we're seeing is the interest rate or the yield on short-term bonds is exceeding long-term bonds. When this happens, it's a phenomenon known as an inversion of the yield curve, and this gets kind of technical. I want to try to keep this relatively high level and so the average person can understand it, but here's basically all you need to see. So take a look up here at the table. This is the yield or interest rate on government debt, and you can see in the bottom we have short maturities, 1 month, 3 months, 6 month, and out here we have long maturities, 7-year, 10-year, 30-year. But what I want to point out is specifically take a look at where the 1-year US Treasury is trading right now, or what it's yielding, 3.2%. That is a higher yield than bonds at the 5-year, 7-year, 10-year, and even 30-year maturity. So this is, again, what we call an inversion of the yield curve, when short-term interest rates are actually higher than long-term interest rates. And economists and investors care about this because in the post-World War II era, to my knowledge, an inversion of the yield curve, what we're looking at here, has happened ahead of every recession, again, in the post-World War II era. Now, the other subject I wanted to matter, the other indicator, if you will, I wanted to point out today is commodity prices. So commodities shot up this year alongside inflation, which is kind of, I guess, classic, if you will. When there's inflation, typically you also see that with commodities. But what's interesting is over the course of the last month, we've really seen commodities pull back, which suggests that the market is anticipating lower demand and therefore lower prices. So specifically, take a look at crude oil, for instance. Crude peaked out in June at over 120 a barrel in the U.S. markets. And I think at the trough, oil prices pulled all the way back roughly 20%. They've slightly ticked back up, but they're down significantly from their highs. That's also true for the global benchmark for oil. And the other one I really want to mention here is copper futures. Copper tends to be sensitive to economic activity because, of course, it's used in a lot of construction material. And look at copper, down significantly from its highs, which again is suggestive, or it suggests that the market is anticipating weaker demand moving forward. Now, let's talk about the contradictory data points. Specifically, check out stocks. So I'm recording this today, it's July 19th, and stocks were up pretty big today. The Dow was up 750, about 2.5%. The NASDAQ was up about 3%. And you certainly could say, this is just one day. It's not really that meaningful. And I agree, but even the trend over the last week has really been on the upside. So my point is, we're seeing stocks rally. At the same time, we're seeing the bond market basically screaming, warning straight ahead. It's very contradictory information. And likewise, we're also continuing to see a lot of strength in the job market. Companies continue to add hundreds of thousands of new workers on a monthly basis. And in fact, the labor market is kind of so tight right now. There's actually a lot of debate in the investment world and the economic world around this concept or the notion that perhaps we experience a recession like we've never experienced before. That being one in which growth slows, but the unemployment rate, hardly ticks up. And of course that has to do with just, again, that tightness. We've been in this situation for quite some time now where there's more job openings than there are people looking for work. So as you can see, it's really a mixed picture. It reminds me of something that Warren Buffett's business partner, Charlie Munger, said a number of years ago. He said something to the effect of, if you're not confused by what's happening, then you're just not paying attention. It really feels like we're in that type of environment where anything can happen. And the fact is, no one knows what's going to happen. But I will say, just a plug for planning. This is why planning is so essential. We know that there are going to be periods of economic turmoil. That is the historic norm. It's amazing. People are always so shocked when you have a big down year in the stock market. But when you look back over decades and decades and decades, these things happen all the time. And this is why having a plan is so critical. You got to be able to get yourself to the other side, because I'll tell you, when stocks go down a lot, they get cheap. And they set up the conditions for outsized returns on the back end. And you got to be there to experience those. You're not going to be successful playing this game of jumping in and out. So anyway, that's my little pep talk. Look, I hope it was helpful today. If it was, hit the thumbs up button. Let me know you liked the video. And I hope we'll see you on the next one.